Hello, welcome to Accounting 2010 Chapter 3 videos, Video 1, What are Adjusting Entries? In Chapter 3 of Principles of Accounting, we are going to start differentiating between cash versus accrual basis accounting. And the difference between cash and accrual basis accounting is under the cash basis, first of all, it is not allowed under generally accepted accounting principles. Under cash basis, what we are doing is when we receive revenue, when we receive cash for services, we go ahead and enter it into our books at that point. When we actually pay expenses, we go ahead and enter the expenses when we pay them. That's not happening in this class. As you may recall from Chapter 2, we were entering revenues into our books when we earned them, and we entered expenses into our books when we incurred them. The exchange of cash had nothing to do with when we entered revenues and expenses. We were going ahead and entering the revenues and expenses when we had earned revenues and when we had incurred expenses. That allowed us to match our revenues and expenses more accurately to reflect the actual amount of money that we were making and keeping. So the general concept that we are going to be applying in Chapter 3 is matching, matching, matching. Matching and aligning revenues and expenses so that we can have a good reflection of the amount of money that is flowing in and out of our business. So how do we do that? How do we match revenues and expenses? Well, we're going to record revenues when we earn them and expenses when we incur them. And part of that effort is going to be at the end of an accounting period, whether it be a month, a quarter, or a year, we're going to have to look around and see what else has been going on in our business that we haven't been recording when the events happen. We've got to go around and ask some questions and decide what has been going on that isn't in our books that would properly reflect the events going on in our business. So first, a major hint. Whenever you're asked to create an adjusting entry, you are going to be using one balance sheet account and one income statement account to do so. So if you are preparing an adjusting entry in your homework or in an exam, always check, do I have one balance sheet account and one income statement account? That will be a hint for you to look for. So what types of things happen that we need to adjust, align, evaluate? This comes out of your textbook, and I'm going to go ahead and discuss this slide. Then in video 2, we will actually create some adjusting entry. So the first type of an adjusting entry is classified as prepaid expenses. Do you remember that we had prepaid for some insurance in the previous videos? Well, as we use up that insurance month by month, quarter by quarter, we need to put into our books the fact that we are using up that prepaid expense. A prepaid is an asset until we use it up, and then it becomes an expense to the business. So the adjusting entry is going to have an expense account debited, credit or remove the asset account, expense income statement, asset balance sheet, one of each. There we can see income statement. Expenses would be understated if we did not write off that we had used up some of that prepaid expense. And on the balance sheet, our asset, in the case prepaid insurance, would be overstated, thus making the equity in our company overstated. The second type would be unearned revenues. So this is the case when we had somebody pay us in advance for services to be performed in the future. And in this case, remember, unearned revenue, it was a liability. Liability is balance sheet. And until we actually go ahead and earn it, we would go ahead and then credit the revenue account. Revenue accounts fall where? Income statement. The effect would be that if we did not do this, that our liability would be overstated, It would look like we still owed too much service. Our income revenues would be understated. It would look like we hadn't earned it if we did not look around and see if we had earned some of that money that we'd been paid in advance at the end of the period. We will be doing some of these in the next video. The next type of an adjusting entry are accrued expenses. This is an expense that has been incurred and not paid. Where could we find that? Well, perhaps, remember that secretary we hired? Well, she had been working, and maybe we're not going to pay her until the next accounting period, but we need to record in our books that we owe that secretary money for her work. And so we are going to go ahead and put it as an expense, her salaries expense for this period as an expense so it can be correctly matched against any revenues we earned. And we're going to record the fact that we owe her money, salaries payable, income statement, balance sheet, one of each. Then we're going to take out accrued revenues. Have we done some work and we haven't been paid yet? So we're going to be looking, have we done work and haven't been paid, and do we need to make some adjustments? We're going to be looking at the asset account and the revenue account. So there are 4 basic types of adjusting entries: prepaid expenses, unearned revenues, accrued expenses, accrued revenues. Each one will have one balance sheet, one income statement account, debited or credited, and we are going to be looking at that using examples of our Roadrunner's Roost of how to create some adjusting entries in video 2.